Are you one of the millions who feel a knot in their stomach at the mere mention of the IRS? Do you worry about unseen eyes scrutinizing your every financial move, fearing a misstep could lead to dire consequences? This pervasive anxiety often stems from a simple lack of understanding, fueled by myths and misinformation. Today, we're going to pull back the curtain on how the IRS truly operates. We'll calmly and clearly explain what information they actually track, and more importantly, what they don't. By the end of this video, you'll gain a grounded, empowering understanding of the tax system, helping you replace fear with financial literacy and confidence. For many, the anxiety surrounding taxes isn't just about the money itself, it's deeply rooted in fear. This fear often manifests as a worry of constant surveillance, a dread of unknowingly making a mistake, or the unsettling feeling that the IRS possesses secret knowledge about your life. These concerns are incredibly common among taxpayers, small business owners, and even young adults just starting their financial journey. This widespread apprehension often comes from a place of not knowing the facts. We hear stories online, encounter anecdotes without proper context, and lack a clear understanding of how the tax system genuinely functions. It's easy to imagine an all-seeing entity, but that image is far from the reality of the IRS's operations. The truth is, the IRS is not engaged in constant, real-time monitoring of individuals. They are not watching your daily spending habits or tracking your lifestyle choices minute by minute. Their system operates almost entirely on reported information, a crucial distinction that can significantly alleviate much of this unnecessary stress. Understanding this fundamental principle is the first step towards financial peace of mind. The core of what the IRS knows about your finances comes from a system called information reporting. This isn't about direct surveillance. It's about third parties providing data. These entities, like your employer, bank, or investment firm, send records to both you and the IRS. Think of it as a standardized communication network. Common examples include your W-2 form from an employer, detailing your wages and withholdings. You also receive 1,099 forms from banks for interest earned, from clients if you're a freelancer, or from platforms like PayPal for business transactions. These forms are critical for both your records and the IRS's. When you prepare and file your tax return, you're essentially compiling your financial story for the year. The IRS then compares what you've reported on your return to the information already submitted by these third parties. This comparison process is largely automated, making it efficient and systematic. It's this cross-referencing of reported data that forms the backbone of the IRS's tracking capabilities, not intrusive monitoring. With all this information flowing in, what exactly is the IRS trying to find? Their primary focus is on identifying mismatches and inconsistencies. They are looking for discrepancies between what you report and what third parties have reported about you. This is a key point for anxiety relief. It's about data integrity, not personal judgment. For instance, if a bank reports that you earned $500 in interest, but that income doesn't appear on your tax return, that's a mismatch. Similarly, they look for simple math errors or missing forms that should have been included with your submission. These are often straightforward administrative issues, not indicators of wrongdoing. Most issues flagged by the IRS are not about intent or suspicion of fraud. They are about ensuring consistency and accuracy across all reported data. If the numbers align between your return and the third-party reports, the system typically processes your return without further review. If there's a discrepancy, it simply flags it for a closer look, which often leads to a simple request for clarification. This understanding empowers you to focus on accurate reporting rather than fearing an investigation. Many common worries about IRS surveillance are simply unfounded. It's crucial to understand what the IRS does not track in the way people often imagine. This knowledge can significantly reduce anxiety and empower you with a clearer perspective. The IRS is not actively monitoring your daily spending habits. They are not watching your personal bank account activity line by line, nor are they tracking your lifestyle choices in real time. The idea of an agent scrutinizing every coffee purchase or vacation expense is a pervasive myth that causes undue stress. Most individual transactions remain invisible to the IRS unless they are specifically reported by a third party, like a large bank deposit that triggers a reporting requirement, or if they become part of a larger, significant discrepancy on your tax return. The system is not designed for constant, intrusive surveillance of every citizen. Instead, it's built for verification and compliance after information has been reported. This distinction is vital for taxpayers, small businesses, and young adults to grasp, fostering a sense of security rather than paranoia. Why does the tax system operate this way, relying on self-reporting and cross-checking rather than direct, constant monitoring? The answer lies in practicality and scale. A system that attempted to fully monitor every financial transaction of every individual and business in the country would be incredibly invasive, utterly impractical, and completely unmanageable. The sheer volume of data would overwhelm any agency. Instead, the tax system relies on a balance of trust and verification. It trusts individuals and businesses to accurately report their income and deductions. This self-reporting is then cross-checked against the information provided by third parties. Follow-up actions, such as audits or notices, are only initiated when significant discrepancies or red flags emerge from this automated comparison. This approach keeps the system functional and relatively efficient at a national scale. While it's not perfect and errors can occur on both sides, it's an intentional design choice aimed at managing a vast and complex financial landscape. Understanding this underlying logic helps demystify the IRS, showing it as a regulatory body with a specific function rather than an omnipresent spy. Grasping the true nature of IRS tracking should be a source of empowerment, not further fear. This knowledge fundamentally changes how you can approach your taxes and manage your financial life. It means that accuracy in your reporting matters immensely, far more than striving for an elusive perfection that often leads to anxiety. You should feel reassured that honest mistakes are common, and the IRS generally has processes in place to address them without punitive action. Most problems that arise from the IRS are due to missing information, mismatched data, or simple errors, not malicious intent. The goal of the system is consistency in reporting, not to catch you out. This understanding empowers you to take control of your financial literacy. By keeping good records, understanding the forms you receive, and accurately reporting your income and deductions, you are actively participating in a transparent system. It shifts your focus from anxiety about being watched to confidence in your accurate and consistent financial reporting. This proactive approach is key for all taxpayers, especially small business owners and young adults building their financial foundations. Now that you understand how the IRS truly operates, you can take proactive steps to ensure peace of mind. Financial literacy isn't just about knowing the rules, it's about applying them to your advantage. For taxpayers and small businesses alike, meticulous record keeping is your best defense and your greatest asset. Keep all W-2s, 1099s, receipts for deductions, and bank statements organized. Educate yourself on the common forms relevant to your income and expenses. If you're a small business owner, understand your specific reporting requirements, like Schedule C or various 1099 NEC forms. Don't hesitate to use reputable tax software or consult with a qualified tax professional. They can help ensure accuracy and identify potential deductions you might miss, further empowering your financial strategy. If you ever receive a notice from the IRS, don't panic. Most notices are requests for clarification or corrections, not accusations. Read it carefully, understand what information they are asking for, and respond promptly and accurately. This proactive engagement demonstrates your commitment to compliance and often resolves issues quickly. By taking these steps, you transform tax season from a source of dread into an opportunity for confident financial management. We hope this deep dive into what the IRS actually tracks has provided you with immense clarity and reassurance. The goal was to replace fear with knowledge, paranoia with empowerment, and anxiety with financial literacy. Remember, the IRS is a system designed for consistency and verification, not constant surveillance. Your accurate reporting and understanding of the process are your strongest tools. If you found this information helpful and empowering, please give this video a like and share it with anyone who might benefit from this clarity. Every like inspires us to create more content that demystifies complex financial topics. Subscribe to our channel for more educational insights that help you navigate your financial journey with confidence. We encourage you to take control of your financial narrative, stay informed, and approach your taxes with a newfound sense of calm. Thank you for watching, and here's to your empowered financial future.